introduction to analyzing the market. So by this time now, you're probably asking yourself, how do you actually go on to, how do you go on about analyzing the market? So in this lesson, we're going to start covering some of the basics on how to actually analyze the markets so that you can get a basic introduction and we don't overwhelm you with a lot of stuff right here at the beginning. But as you go on with the rest of the course, you get a better understanding. But these are the crucial basics, the introduction phase that you really need to get to know and really get to implement in the next sections that are coming. So you may find making your trading plan fairly easy. Now the question is, how do you actually analyze the markets? So one of the most common ways is through the use of price actions. So price actions, different things that we're going to break down right now. So price actions, just when interpreting what the price chart is actually giving you. So the markets, what are they saying? What are they doing, right? So you have, that's where we implement our support and resistance, reading the candlestick patterns and all that stuff. So let's just get started. So basically, what are price charts? So price chart plots the recent price of currency pair on a graph and provide snapshots of the market movement over a particular period of time. So remember, I showed you about the time frames, the 1 hour, 15 minute, and as you can see right here with Euro USD again on H1. So this is the H1 is basically just 1 hour time frame. So that means for every candlestick that you're seeing on the graph, or for every from one line, from the beginning of one point of this line to the other point, it will take actually 1 hour. So it will take basically 1 hour to be able to complete that candlestick, to complete that pattern from where it started to where it ended, right? So this just means on a bar graph, each bar is worth 1 hour. It takes 1 hour to open and close one of those bar graphs. So in one of those candlesticks, or that particular segment of that line graph that you're seeing on the chart. So right now we have three commonly used types of charts. So we have the line charts, we have the bar chart, and the candlestick chart. So there's actually more than that. So if I can take you back to trading view again, you can see that right here. If I click on here, we have a bunch of different types of charts, right? But the mostly commonly used that you find on MT4 and MT5 is the candlesticks, which are basically my favorite and easier to understand. And you find the bars, and you also find the line graph. So these are the three that you'll be able to go through. The bars, they basically look like this. So they look like that, and then you have the line graph, which look like that, and then we basically have back to our candlesticks. So let's just go back to our candlesticks, candles right there. So remember, as I said, each candle represents 15-minute chart here on the 15-minute chart, and then if we take it to 1 hour, that means each candle it actually takes 1 hour from the time it opened to the time it closed. And then for the next one to open as well, that means 1 hour for each of these candles. That's just basically what it means when it comes to time frames and everything. So each time frame, each candle right here, so each candle can be broken down into smaller time frame to really see what it went down. Because as you can see, for example here, this candle opened right here, right? So this is the opening price, and then it went down all the way here, and then it retraced, left a tail, just a tail, or we also call it a wick, and then it closed somewhere above here. So to be able to understand what actually happened during this point in time right here, you can break it down by going down to a smaller time frame and look at the specific candlesticks, and you'll be able to see, okay, this is the patterns that formed, there's the candlesticks that formed, and it created this support and resistance. That's why it turned around and all the stuff. So that's just basically the why we have different time frames, is just to look deeper and to basically break down each candle that is on a higher time frame and see what is going on the smaller time frames. So let's just go back to our, so this way, line charts, one of the most common chart that one of the three common chart types that most traders use. So they provide a quick way to view the changes in price movements over a period of time. So and then we have our bars and candlesticks. So the bars and candlesticks, as I showed you on trading view just now, we have bar and candlestick charts provide an easy to analyze appearance that displays detailed information about the price movements of a currency pair. Hence why I said candlesticks are actually my favorite, because they provide more details, more details in a more graphic scenery, so that it makes it easier for you to actually understand what is going on, much better than compared to the line graph. As you can see, the line is just, it's easier to draw the support and resistance, on the line graph, but for more detailed plan to really understand what the market is doing, candlesticks, the Japanese candlesticks are the best to use. So So each bar or candle on the chart is defined by 4 price movements. So there's the high, there's the low, opening, and the close. So if I can just quickly show you on here. So if you look at the top here, we have the O for opening, we have the high, the low, and the closing price. So if you go for every candlestick, you will see that it's different, right? So it's showing you where the trade opened, where the highest point that it went, so the highest point where that it went, and then the lowest point that it went, right here at the wick, right here at the bottom, and then the closing price. So the closing price of this candle is right here, the opening is here, because this is the bullish candle. So it opens low, it closes high, that makes it a bullish candle. If it's a bearish candle, it opens high, it closes low. So that's basically, and then we have the wicks on both sides. So if the market is tested a higher level but then decides to close a little bit lower than that level, that's how the wicks are formed. The length of the bar or candle represents the level of trading activity for a specified period. So for example, on a chart with a 10-minute time scale, a bar or candle appears one color, usually green, and when the price of the currency pair drops, the bar or candle appears another, usually red. So there's just 2 different ways to separate the two. So the bears and the bulls, as I just showed you right now on TradingView. So most traders switch between different time frames so that they can compare market movements and verify trends. So as I said, the top down analysis, you start from the top, you analyze from the top. So you start, maybe you want to trade on the 15-minute chart. That means you're going to go to your 1 hour, and then you're going to go to your 1 hour time frame, you check the trend there, you come down to your 30-minute time frame, you check the trend there, and then you finally come back to your 15-minute chart, and then you wait for a confirmation for the trend that you've overall found on the 1 hour and 30 minutes. So if it's both a buy, then that means you're just waiting for a buy confirmation on your 15-minute chart frame. So that is what we mean by verifying trend. So to verify a trend, that's just basically you want to really know what is happening on the upper time frames, so that when you enter on that smaller time frame, you basically understand that you have a confirmed trend, and it's not just based on that time frame that you are trading on. So you can start at 1 minute time frame and even view monthly time frame. So as I demonstrated earlier in the video, so as you can see, this is a bit more, it's illustrations of the bar charts and the candlestick charts, but I already showed you on TradingView. So let's move on to the next chart. So now, what is technical analysis? So when it comes to technical analysis, it is basically a study of repeating patterns and movements in the market caused by the pattern-like behavior of the traders. So traders usually use technical analysis to monitor current and historical price movements of a currency pair. So it also helps us to determine market trends and forecast potential entry and exit points for our trade. So it's almost like weather forecast, right? So we sit down and watch the weather to see what is coming up next, and following days the weather is going to be hot or cold or raining. So it's almost the same thing here, but you just have 2 directions. As I said, it's either you're buying or you're going short. So it's either you're buying or you're selling. Because no traders are alike, there are hundreds of technical analysis tools and methods to choose from. So here's an example of some of them. So right now we have the support and resistance levels. So what is meant by support? So this, I want you to look this at a like double-story building. So we have a floor, and then we have a roof right here. So we have a roof right here. We're just going to make this our roof, and then this is our floor, right? So we have a floor, and then we have our roof right here, and then above that, but then this is a double story. Remember, this is the first floor, and then we have a second floor, right? So another roof will be right here, right at the top above that. So that means now for somebody who is here, that means they are stepping on this floor. This is their floor, this is their floor, this is their floor, this is their ceiling, and then this is for somebody who is here at the bottom. This is basically their floor, and this is their ceiling. This is just like simplifying the what is support and resistance in the sense of a building, right? Of a double-story building. So for you to be on this floor here, on the second floor right here, you have to break through this, right? You have to break through this full body. You have to be above this to be able to be on the double floor, on the second floor of this building. So that's exactly what is happening here. In the market, we have what we call the support. So the support is going to be your floor. So the support is your floor. So as you can see right here, the price broke through that, but before that it actually bounced here. So it bounced here. So it's like the support. It's supporting the price to stay afloat, to stay above the ceiling, to stay above the floor, right? To either stay above the ceiling or stay above the floor. So that's basically what our support does. And then we have what we call a resistance. So resistance is a point where the price has respected at least twice okay, both sides, even though on the support, it has to respect the point at least twice, right? So here you can see it supported it twice, at least twice, right? So that's when you can plot that support and resistance when the market has touched that point at least twice. But I want you to think of support and resistance as zones, right? Not specific points like what we have here, right? You can obviously break it down and have a certain point where you say, okay, this is the most respected point on this support and resistance zone, but have it as a zone and understand, okay, cool, at this zone here we have our support and resistance, the market is doing this and that, right? So, and then you have a more defined point where you say, okay, cool, this is the most tested or the most tried support and resistance zone in this section, right? So support and resistance, one of the most crucial terms that we're going to be using throughout this course. So I want you to really get to understand what it is all about. So I hope you're actually following with this booklet so that you can go and read through and just take a look at this, practice it a bit more. So again here, as you can see, we have our first touch and second touch, which confirms that this is a support. The price is being supported to stay afloat, is not breaking through. And then on the resistance right here, you're seeing that this one right here is, so the market came through. So when the market is above the line, it's obviously this will be acting as support. So this will be acting as support as well. But as soon as it breaks through like this, it now becomes a resistance. So it's resisting the market from going back up. So that's why we call it resistance. So it's like our ceiling. It's our ceiling blocking this guy from going above to the next level through there. So right, so it will just keep on bouncing until it finally breaks through. So as soon as it breaks through, then the resistance right here becomes our support, because the market will be playing above, right? It will be playing above here. So once the market is playing above, it becomes our support, our resistance changes into support. So that's basically what happened here. It was first our support, it broke through, and then now it's a resistance, it's resisting. And then here, as you can see, this is our support at the moment, right? It's supporting the price, it's protecting it from breaking through, so it's supporting it. But then as soon as this market decides to break through, let's just extend this a little bit. So as soon as it breaks through like this, and then comes to test here, our support is now resistance. So it will be known as resistance because it's now resisting the market from trying to break through that point. So that becomes a resistance. So I want you to get this point that resistance will turn into support and support will turn into resistance. So that's just a quick illustration and demonstration, introduction to support and resistance levels. So I hope you actually got the clear picture that I'm trying to paint for you here. But anyways, these are the two, these levels are price points that the market consistently hits and then reverse its direction. So support usually refers to points that the price drops to but never breaks through before rising again. So the support, it just comes and touches there, it touches there, and then it just never breaks through, right? And then the resistance refers to the points that the price rises to but never breaks through before dropping again. So as you can see, it hits it, it drops, it just drops every time, right? Until it breaks through that point, right? So as I said, it has to hit it at least twice before you can confirm that it's a resistance or it's a support. And then we have indicators. So this is part of the technical analysis. We have indicators as well. So right here we have one of the most common indicators used, and this is called the Bollinger Bands, but there's a bunch of indicators that you can use. Okay, so indicators, basically they're either on the chart like what you're seeing right here, or they're usually at the bottom, right? So you have a second screen at the bottom right here, and then you have your indicators. Some of the most common ones here are actually called the RSI, so the relative strength index. So that's one of those ones that you see at the bottom of your chart, or the Bollinger Bands example right here. It will be directly on your chart, it will be attached on your main chart. So basically it's either on the top, it's either on your chart showing you the movement, or it's separate at the bottom of the screen like this, right? So the MCD, all those kind of things, like the RSI, as I said. So Bollinger Bands, average directional index, and moving averages are all examples of indicators. Indicators can either be lagging, these analyze past market movements, or leading, this focus future price movement. So they might show you, okay, cool, like the Bollinger Bands right here. You can see that it is actually showing us directions right here. It's showing us directions, and it also shows us a level where the market can come and test, right? It can show us the point where the market can actually come and test. So you can have your if you're using your take profits and trailing stop loss, you might want to look at those positions and so forth. So depending on the indicator that you're using, right? So that's just a quick introduction on indicators. So there are plenty of them. You have to choose which ones works best for you. But anyways, coming to our last slide here for this introduction to the basics. Right now we have different patterns on this chart right here. So this is actually also part of technical analysis. So remember, we have patterns, we have different charts, and we also have indicators, right? But these are patterns. So on the patterns, we have what we call the W formations. So this is a W formation right here. It looks like a W. It represents the letter W, if you can see. We also have the opposite of it, very much the same thing, but this one will mean bearish, so the market is going down, and then this one will mean is the market is bullish, so the market is going up. So this is just some of the patterns. You have the flag, as you can see right here. There's another one, and then you have the new support. So the new support and resistance. You have the low of the day. So this is a W formation at the low of the day. So this is a strong confirmation to say that the price is going up, because you are at a support, which is the lowest of the day, according to this USD/JPY formation that was happening here on a 15-minute chart. So you have other price patterns that we have, candlestick patterns. So this is called a pin bar. So a pin bar, if let me see if I can quickly show you a pin bar on a clearer note. So the pin bar is something like this. So we have a head that is, the colored part of the body has to be 2 times the size of the tail. So if it is at least 2 times of if it is at least 2 times the size of the tail, then it's a confirmed pin bar, and it can be inverted hammer or just a hammer as it is right now, and it's either a bullish. It can be both a bullish, bearish indicator depending on where it is situated on the market. So this is actually one of the most common patterns that we use. And then we have some things like dojis and so forth, but we explain all the necessary ones that you need to learn as we go on deeper into the analysis part of the course, right? So you have the W formation right here at the bottom of the day, at the low of the day. You have your bull flag right here, which just shows a retracement in the market. So it's basically just showing a retracement, which can be a potential for you to re-enter a trade if you had missed it right here at the bottom of the leg, or you can add more entries, right? Maybe you already entered right here. Then you just enter more trades as soon as this bull flag is broken. It has broken through the. So we demonstrated the horizontal support and resistance, but we also have what we call vertical, but I would like to call it diagonal resistance, support and resistance, which are these lines that you're seeing right here. So they're diagonal, but they're basically representing support and resistance to show you where the market is bouncing off, and basically give you like a future forecast on where the points where the market can basically try to touch again, or hit, or at least break through. So when you see a break like this, that just means the market has broken it's broken out of that cycle and it's going up. So there's a clear break right here, and then as you can see, we had a new support being set up right there. But remember, as I said, a support is once a resistance. So here it was a resistance resisting the price will push down, and then it went back up, it broke through that, and then now it's a new support. So as you can see, the second leg of the W, a very powerful entry confirmation, especially when you have a pin bar, which is just hidden underneath this W formation coloring, but basically it's a pin bar that showed you how it actually looks like. Remember, it must be the head, the colored part of that candle must be 2 times longer than the wick or the tail of that candle. So then it is a confirmed pin bar or hammer, as most people might actually call it. But anyways, a chart pattern is a series of price points that move in a particular arrangement, and once completed, focus market movements. So it just like helps you to predict the future of a market. And then some common patterns are flags, channels, and triangles. As you can see, this is a form of a flag, but it's also a channel, so it's a downtrend channel type of thing. And then you have triangles, so this is just a lot. Okay, so it's a lot of them. And then you can also plot more complex patterns such as the ABCD patterns or Fibonacci levels. So those we also demonstrate later, the ones that you need to know about. So the last form of analysis that I talked about was the fundamental, when I gave you those 2 links that you can go check out the news, the fundamental news. So that just means that you're trading based on news, you trading based on events that are coming out. So if maybe a president of a certain country says that something negative about the economy and all that stuff, that means usually those news is basically going to have a negative impact on that currency of that country. Maybe it's United States trading against the euro, or the euro against the United States, and then basically if there's negative news in the United States, that means it's going to lose value, meaning that the other pairs, any pair, so if we have negative news on USD, right, on the United States, that means any pair that it looks like this, USD with whatever here, maybe it could be JPY, or it can be euro, it can be euro USD, as we've been demonstrating throughout this video, throughout this course right now. So that means if the negative news is affecting the USD JPY, that means this market right here, the graph for this pair right here is potentially going to go down, and then the graph for this is potentially going to go up. Why? Because remember, when you're buying or selling, then you're saying that this is going to either gain momentum or it's going to lose its momentum. So if the news are negative, that just means it's going to push it down. So it's going to go down, it's losing its momentum. This right here is gaining momentum. And then if the news is negative, it's still negative for the United States, but then it's on the other, it's now here is not longer a base currency, it's called the core currency, as we demonstrated in the beginning of the course, is a core currency at this moment. So that means this chart right here is going to go up because this one is losing its value, this one is gaining its value. So that's just basically a quick introduction to what I can say about the fundamental analysis. So fundamental analysis, traders track these political, social and economic forces and then focus whether the value of the currency will go up or down, depending on whether it's positive or negative impact that the news is going to bring out, right? So you learn that the value of a currency pair changes in response to news. Interest rates, these are very crucial. These are very crucial. So interest rates, government decisions and other events. So as you watch the charts, you will notice the events and the news on the state of the particular countries or regions economy can cause currency markets to shoot up or down dramatically. So that's when I was explaining that you can see like a huge candle on a 15-minute chart that would be like 1,000 points movement, in an instance of like a few minutes, right? So many new traders will develop their fundamental analysis skills by following news, events and scheduled economic announcements. But there would be times when the price movements of a currency pair won't behave as you believe it should based on the fundamental analysis. So that's when it becomes important to incorporate technical analysis into your strategy as well. So it's best to be both a fundamental and technical analysis, as this will help you with your trades, and basically, in the events that maybe news don't actually move the market as you anticipate, a technical side will help you still catch some of the trades, right? Catch trades based on technical analysis instead of just fundamental analysis. So we basically come to the end of this introduction to the basics, very basics of Forex. So the next lessons are going to be more detailed and more practical, and we're going to dive a little bit deeper into the real things that you're going to need to learn, the skills that you need to learn, and basically master this thing called Forex trading. So I hope you still enjoying this course this far and everything's going well. So I believe I've tried to simplify everything, very basic. And again, as I said, I recommend that you actually follow along with the booklet that we've been provided with, so that you can read through it on your own as well to get a better understanding and follow along with this video. So let's jump into our more detailed lessons from now on.